The budget, November 2025. What are the main changes that could affect you? Stay tuned. Hello and welcome to the Alison McWhinnie podcast, where we have conversations about business and wellbeing success. And today I'm delighted to welcome Rupert Adams to the podcast. He is a financial advisor and he'll be talking about the most recent budget and the implications for us. So without further ado, over to you, Rupert. Perhaps you'd like to start off by just giving a fuller picture of yourself, and then we'll go straight into the budget.
Yeah, thanks, Alison. As Alison said there, I'm a regulated financial advisor. But in a previous life, I was an officer in the British Army. I did that for about 7 years. I then left and sort of retrained, and now I'm a self-employed financial advisor working with a company called Ember Wealth Management, and that falls within the St James's Place sort of partnership. I guess why do we need to talk about the budget, right? Well, I mean, I'm sure everyone would have sort of trailed it in the news. It causes a lot of stress, a lot of emotions, a lot of panic, for many people. The budget happened last week. The world still goes on. Okay, but what's really, really important is that we kind of, understand some of the big changes and how potentially it might impact you and your finances. So I'll kind of break down the main announcements. I'm not going to go through all of them. Just because there was quite a few. We simply wouldn't have the time, and also they get quite niche and technical. So I'll go through the ones that I think would be most applicable to most people.
Wonderful, thank you.
So, the bottom line up front, really, as expected, this was a tax raising budget. The tax burden now is the sort of the highest since records began, and about 38% of GDP. It was obviously expected that this was going to be a tax-raising budget given the state of the economy. But it's going to raise about 26 billion over the next 5 years. So a significant increase, especially after sort of last year's budget, which was meant to be the one and done sort of strategy from Labour. Clearly, they have had to come back. The big macroeconomic picture means that the Chancellor's headroom, fiscal headroom as it's known, which basically means in the final year of the forecast of the government, she needs to be running like a surplus, a surplus on the accounts, if you want to say, because then if growth doesn't come in as well as expected, or tax receipts don't bring in as much as they forecasted, then there's a bit of wiggle room, because she needs to be running a surplus in the final year. So that's doubled. That's doubled from about 10 billion to 22 billion, which has been the main the main effect of this budget. But they had a couple of options, government, and up until about, I think it was a week before the budget, they were looking at increasing the main rates of income tax, which would have been a break to one of their main manifesto pledges. That was then sort of reversed last minute. And instead, they've kind of opted for the more sort of smorgasbord approach of tinkering with various bits across across the various taxes. And really, that's being designed to really garner support of the backbenchers. Really, some of the changes that they've put into, or the commitments that they made in the budget, and really, quite frankly, to firm up the leadership, which was has been struggling over the last couple of months. And they have been very careful to sort of slowly implement these changes. So we'll go through it, but a lot of them are taking effect sort of in kind of the final years of the current government before the next general election. With a lot of the borrowing kind of happening up front in years sort of 2 and 3 to fund the spending pledges that they've committed to, to sort of please backbenchers. And then most of the tax rises coming in sort of years 4 and 5, which means actually then most of the kind of the fiscal adjustments, the changes to the taxation, that's not really going to bite until the sort of the last year, right before the general election, which does seem like quite odd timing, considering you wouldn't think, government would want people to feel the effect of tax raises just before a general election, which is interesting. So, perhaps maybe they're hoping for growth, as they've been trying desperately to achieve. They're hoping that's going to come up earlier than perhaps forecasted, which means actually maybe come the general election, maybe they won't have to implement some of these tax rises, or they can scale them back. Having said that, though, the OBR, saw no reason to adjust their growth forecasts, given what was contained and proposed within the budget. So they're hoping for growth, but not necessarily, implementing changes to incentivize growth. So that's the kind of the broad sort of macroeconomic sort of context, for the budget. In terms of the reaction, fairly positive from the kind of the bond markets, the gilt markets, and that's mainly because the Chancellor's headroom has been doubled, which basically means that the chance of her having to borrow more are reduced, because she's just got a little bit more wiggle room there. Or if the tax, she can't raise as much tax as she's hoping. So yeah, a genuinely positive reaction from the markets, but really the devil will be in the detail, and that will come out over the kind of the weeks and the months, as it always does. So we'll go through kind of the main headline changes now, but I will stress we're still fairly hot off the press here, so often things do change. The Chancellor kind of gives you the wave tops, but actually when the detail comes out, things will change. So so subject to change, is what I'm saying. So it might not be exactly the exact announcements here. So yeah, the main one then, that was income tax thresholds being frozen. Okay, so as everyone is hopefully aware, you start paying tax at a certain threshold. So this is income tax. So that's called the personal allowance at £12,570. After that, you move into the basic rate, which is just north of 50,000. Then you move into the additional rate, where you're paying 45%. So those thresholds where you start then paying the increased rate, they've been frozen, and they have been for a while. They were frozen until 2028. Now they're going to be frozen until 2031. So what does that mean? So it doesn't mean that you're going to feel an immediate sort of change to the amount of income tax you're paying, but as everyone's salaries increase each year, which we'd hope they will, the cost of goods go up with inflation, so we'd expect our salaries to increase as well. As that happens, if you're freezing the threshold at which you start paying that tax, then you're effectively going to get dragged into a higher tax bracket quicker. And that's what's known as fiscal drag. So it's sort of like a stealthy way of raising more tax. No, you're not changing the headline rates, but just more people are going to be paying a higher rate of tax. And that's forecast to affect about 1 million people, which is a substantial amount of people. But really, it'll be, the bulk of that tax raising, about 8.3 billion is what they're forecasting. That's really going to happen in sort of 2030, 31, sort of, after the next general election, which that's when it will really start to bite. So yeah, interesting timing for that. Yeah, but in short, people, the vast majority of people aren't going to feel an immediate rise like they would if there was an extra 2% put on the rate. But as salaries increase, they'll start noticing, oh, I'm paying, I'm now a high rate taxpayer, or I'm now additional rate taxpayer. So that was the main one. The second sort of tweak to income tax is an increase to the rate of dividend tax. So this is going to take effect from next April, so 6th of April 2026. At the moment, so this is pertinent for sort of business owners who might pay themselves, they'll pay a bit of salary, but then they'll pay the remainder of their remuneration in dividends. At the moment, you've got a dividend allowance of £500, and then on the basic rate, you pay 8.75%. Higher rate, you pay 33.75%, and then additional rate is 39.35%. So they're slightly lower than the income tax rates that you'd pay on salary. These are going to rise, or at least the basic and the high rate will rise by 2%. Okay, and that's from next April. So what it basically means is, if you're a company owner, and you're paying yourself in dividends, you are going to be paying more tax from April 2026. There's no getting away from that. And the rationale here is that dividends are share of profits. It's not salary. Therefore, it's not sort of earned income, or it's not sort of taxable or sort of pensionable income. So the argument is, oh, you should just pay yourself in salary instead. At the moment, it's sort of more efficient to, in terms of getting the money out of the business, paying yourself in dividends, paying corporation tax on that within the business, but then having a lower rate of income tax, the dividend rates. That's going to be, after these changes, the increase is not going to be much difference now, but between those two different types of paying yourself as a business owner. But the allowance, the £500 allowance, that's not going to change. It's been heavily reduced over the years, but they're going to keep it at £500. So that was a kind of surprising one. The next one is less surprising. So that's an increase on tax on property income. Again, property just generally is sort of real low hanging fruit for a Labour government, and various reforms and rules have been brought in, which is just making it less and less profitable to have like a kind of a single buy to let property, for landlords. So this change will take effect from the 6th of April 2027. Okay, so sort of 2 years. Basically, they're just adding a 2% increase onto the income tax bands, but for property income. So for property income, if you're a basic rate payer, that'll be 22%, higher 42%, an additional rate will be 47%.
Would that affect income from people who use properties for Airbnb rentals as well?
Yeah. So if they're kind of the owner of it and it's not incorporated, they're going to be paying an increase to the tax they're going to be paying on that. And the furnished holiday let regime that was used by many, that was abolished, or that has been abolished.
Mm-hmm.
So again, that was an increase. We expected there'll be something on property, and again, the argument is that this isn't earned income. This isn't someone going out and working. Although I think many would disagree with that in terms of it takes a lot of work to manage a property and to be able to keep a nice home for someone to then live in.
Sure.
But arguments either way there. The second sort of change or third change there is a tax on savings. So again, this is from 6th of April 2027. So at the moment, everyone has something known as a personal saving allowance. So for basic rate payers, that's £1,000. For high rates, that's £500. And for additional rate taxpayers, they don't get a personal saving allowance. What that basically means is if you've got sort of money sitting in a bank, in a savings account, it's earning interest. If you're a basic rate taxpayer, you could, the first £1,000 of that interest, you won't pay tax on. But then after that, you'll be liable to tax, and this is per tax year. It doesn't apply if it's in something called an ISA, if it's in like a cash ISA, because that's like a wrapped investment. So this is kind of unwrapped as it's known.
And presumably, if you've got several savings accounts, they'll be looked at together rather than individually.
Exactly that. So it's assessed on all savings interest over the course of the tax year.
Yeah.
How much have you earned? So much like the increase to the property, they're putting an extra 2% on the three bands there. So 22%, 42%, and 47%. Again, the argument here is that it's not earned income. It's cash which is just sitting there, and they're going to be charging you more tax on that. This is an interesting one, because one of the other changes they made is, again, from 6th of April 2027, is they're going to limit the amount you can pay into a cash ISA. So at the moment, everyone has an annual ISA allowance of £20,000. That's per person. So you can pay £20,000 a year into whichever ISAs you want: cash ISAs, stocks and shares ISAs, lifetime ISAs, which we'll come to. You just can't pay in more than £20,000. This is per person. From 2027, they're going to cap the amount that you can pay into just the cash proportion of it to £12,000 a year. So you're paying, from 2027, you'll be able to pay less into a sort of a protected tax efficient wrapper known as the ISA, and then anything that isn't going into that, there's then going to be an increase to the amount of tax that you're potentially going to going to pay on that. So it's kind of like a double whammy.
Yeah.
They're really going after that savings income. The remainder of that £20,000 allowance, so £12,000 in cash, 8,000, that can go into other ISAs, and ideally it would go into a stocks and shares ISA. Now, the thinking here is that investing in cash isn't a meaningful way to build wealth over the medium to long term, which I completely agree with. It's not. But from my experience, the reason why people don't invest is because they lack the time, the confidence, or the knowledge. So essentially what they're doing is they're decentralizing you to saving cash, but that's not going to change the fact that people want to invest, they just don't know how to, or they don't feel comfortable. So that's not really tackling that issue. So we'll see how that works out. Maybe it's going to rise, it's going to increase the amount that they're obviously going to take home, the government's going to take home from savings. However, it should be said that the vast majority of people at the moment don't pay tax on their savings interest because of those personal saving allowances. But there is a carve out here. So if you're 65 and over, you'll still have your full £20,000 allowance, that you could use for the cash ISA. And the idea here is, this isn't a tax, this isn't a revenue raiser, this measure. It's encouraging people to invest in the accumulation phase to allow them to, to retire and not have to be reliant on the state. Clearly, if you're 65 and over and hopefully you're looking at retiring, you might not want to be investing your excess money in stocks and shares, which are higher risk. It would be more potentially more sensible to leave it in cash. But again, really, really important to kind of review everything that you have, and to work out, whether it is right to invest or not. So the next change is a change to salary sacrifice arrangements. So this is going to come into effect from the 6th of April 2029. So feels very, very far off. But the reason why is because this is potentially going to cause a lot of difficulties for businesses to process, to administer. So they're going to need time to work out, okay, how are we going to implement this change? So salary sacrifice arrangement is a way to contribute to a pension scheme. So it could be like your workplace pension. You essentially just sacrifice some of your salary. So say you're earning £50,000, actually, you say to your employer, pay me £45,000 and put the rest into my pension, and that could be done on a monthly basis. The advantage is that you save, income tax, because clearly, you're not technically earning that anymore. But then also you save national insurance contributions. You personally save them, but then also the business would save them as well. So employer and employee national insurance contributions. So it was like the most tax efficient way of saving into a pension. But it was more expensive for the government because they were missing out on the income tax and then also national insurance contributions. So the change from 2029 is going to be a limit, a cap that you can pay into a pension using a salary sacrifice arrangement of £2,000 a year. Okay, so a pretty big reduction. So it's going to be £2,000 a year. You can pay more in, via these arrangements. You're just not going to get the national insurance savings above the £2,000 limit. And that's expected to bring in about 4.7 billion for the Treasury, which is a significant amount of money. At the moment, it's a lot of people are using these schemes, particularly for things like bonuses, where potentially they didn't need the money, and they were just happy for it to be a bonus sacrificed into a pension. So that's still going to be possible. It's just not going to be quite as tax efficient. But it still remains, pensions are the best way of saving for retirement. I wouldn't want that to put anyone off thinking, oh, what's the point? There's no point paying into my pension anymore. It's just going to keep changing. Yes, there may well be other tweaks, that almost definitely there will be, but it's still a fantastic way to save for retirement. The tax relief is really, really good still on it. It's a really, really good incentive to save, and it's it's there just growing and invested for retirement. So please don't let that put anyone off. The next one then was a slight tweak, or not really a tweak, just a freezing really of the inheritance tax threshold. So in the last budget, there was a fair bit change with regards to inheritance tax. They haven't really made any tweaks here. They've just frozen the thresholds for longer. So at the moment, every individual has something known as the nil rate band, which is 325,000. So you can pass that on, on death to your beneficiaries, and it wouldn't be subject to inheritance tax. Now, if you're passing on a property to a direct descendant, then you also benefit for something called the residential nil rate band, which is an extra 175,000. So you put those two together, and that's 500,000. You have two couples, and then on second death, they could pass. Sorry, if you have a couple, you on second death they could pass on £1 million inheritance tax free before they would start being liable for tax. So those thresholds that I just outlined, they were frozen, and they're going to be frozen for even longer until 2031. So similar to the income tax thresholds. And that's expected to bring in as much as about 14 billion, or more over the Treasury over that period. Whereas much like the kind of the fiscal drag, similar thing happening here. People are then going to be start going to be dragged into that, in inheritance tax sort of, or they're going to start paying inheritance tax. If you think in London, it's not inconceivable to have a property that's worth, £1 million. And so anything above that, that's going to be liable for inheritance tax. And from 2027, pensions, this was the big change last budget, pensions are going to be brought into the estate, for assessment for inheritance tax. So again, a huge change. And I've been doing a lot of inheritance tax planning recently, and it's a really big concern for people because they don't want their beneficiaries, their children, to be faced with a huge bill that they'll have to pay before potentially before the estate can be unlocked. Yeah, then the next one was a kind of a bit of a surprise, really. I wasn't really tracking this. I hadn't really read anything about it. So it's a change to Plan 2 student loans. Okay, so what Plan 2 student loans? Well, for students in England, it's for those who have a student loan and they started uni between 2012 and 2022. For Wales, it was from 2022 onwards. So if that's you, or if that's one of your children potentially, there's a threshold at which you start repaying the student loan. So it's an extra 9%. It's a tax essentially. So it's 9% of your earnings above this threshold. You'll start paying that. So currently the threshold's £28,470. So that's actually going to go up in April to £29,385. But then it's going to be frozen until 2031 after that. So again, much like the other, the inheritance tax and the income thresholds, that's just going to drag a lot more people in. So as again, salaries increase, people are just going to get to that threshold a lot quicker. And so, people in that circumstance are then potentially going to be paying more income tax because they're getting dragged into a higher threshold. And then, they're going to feel the effect of the student loan repayments as well. And that's 9%, each month. And that could be on top of 40% income tax, and national insurance on top of that. It all starts adding up quite quickly.
Indeed, yes.
So yeah, hadn't really trailed that at all in the news. Wasn't really expecting that, but yeah, anyway, that's coming into effect. So the next one is the lifetime ISA. So a lifetime ISA is, you're allowed to pay £4,000 a year, a maximum of £4,000, and this does use part of your £20,000 allowance into a lifetime ISA, and the government will give you a 25% bonus on that contribution. So if you pay £4,000 in, they'll put in £1,000. And they're designed for two purposes. The first is for first-time buyers, and the second, if you don't use it for first-time buyers, then it's for retirement. The sort of contentious issue at the moment is that there's a cap that you can use to buy your first property, which is £450,000. And that's stayed at that level for a very long time. So whilst that's probably not an issue in most of the UK, certainly in London, a lot of people who have been saving into a lifetime ISA over a number of years are suddenly finding that, oh, actually the property that they intended to buy, they now can no longer use the lifetime ISA for, or they can, but then they have to pay a penalty to get the money out of the lifetime ISA essentially. So it's seen as a bit punitive. So there haven't been any changes announced. However, a consultation which will start in January has been announced. So that will look at replacing that lifetime ISA with something that could be called a first-time buyers, ISA. We're not sure. It doesn't quite have a, as nice a name. But they're also considering, or they're going to be reviewing this limit, the 450,000. What that looks like, we're not sure. But good progress in the fact that it's going to be reviewed. Yeah, the next one, which I think won't affect the vast majority of people, but I think they'll probably be interested in knowing anyway, is what's known as the high income property surcharge tax, or will never be known as that, but will be always known as the mansion tax. So that was again heavily trailed, and that's going to come into effect from April 2028. So still a couple of years. And that's going to be essentially just a surcharge on top of your council tax. And it's going to start at properties worth over 2 million, where it's going to be £2,500 a year. And then it's sort of tiered upwards when you get to the kind of lofty heights of 5 million plus, and then it's £7,500 a year. That's going to be very difficult to implement because valuations of properties are notoriously difficult to assess and then to constantly assess. But we are aware that the valuations will be, or the valuation office will basically go out and do sort of extensive revaluations of expensive properties, and then the 2026 values will be used, and those will be inflation linked as well. Again, what exactly that looks like, but we're not exactly sure. Interesting though, if you might know someone, or you might be someone who lives in a property worth over 2 million, but you don't necessarily own it. You might be renting it, so the tax is going to be levied on the owners, not the tenants or the occupiers. So that's only expected to bring in about 400 million a year, which, or sorry, 400 million, which again isn't going to change the price of fish too much, but again, a bit more one for the backbenchers, I think. In terms of they wanted to see something, whether it was a wealth tax or sort of a mansion tax. But again, as now that those sort of thresholds are in place, it's if they don't change, or if they stay frozen for a very long time, we're going to see the same effect. The stealth tax of bringing homes into those limits. The next big announcement was the scrapping of the 2-child benefit cap. So that will take place from April next year, so 2026. So this isn't to be confused with child benefit, which is a payment that you could receive, per child. This is specifically related to a cap on universal credit, and based on the number of children you have. So this is something that was the Labour government been talking about for a very long time, and other parties as well. The argument here being, I think it was first introduced by the Conservative government because they wanted to. The idea is for if they had a benefit cap, it would stop some households who are on benefits having more children. Some data suggests that that hasn't necessarily been the case. So they've decided to remove the cap to try and attempt to lift children out of poverty, i.e. providing more benefit income to those families. And it's assessed that could benefit about some 450,000 people according to the OBR, which is a significant number of children.
Mm-hmm.
And then the next big one was the state pension. So that was kind of announced back in September for the next tax year. So in April, at the moment it rises each year in line with the triple lock, which basically means that it's going to rise by the greater of 2.5%. The rate of inflation or average earnings growth, the increase in average wages. This year it was that number. The increase in average wages was the higher. I believe it was 4.8%. So the basic state pension will rise by £440 a year, and the new state pension by 575, which means it's going to be sort of flirting with the personal allowance. Next year will still be slightly below, but if that's your only form of income from 2027, because we know it's going to at least rise by 2.5% the following year, it will be over that personal allowance. So, you could then be liable for income tax if that was your only source of income. The government has since come out saying, they're going to have a simplified way to pay for those individuals to pay tax if they do pay tax at all. Again, we're not quite sure yet. But if it's not your sole income, then you will pay tax on it, as any other income. Good news stories then, just a couple to finish off, is energy bills. So from 6th of April next year, it's 2026, there's been a bit of a reshuffling of deck chairs in terms of how some sort of levies and policy costs are taxed and how they're taxed, and they're going to be moved to general taxation is sort of my kind of understanding of it. And they're abolishing an eco scheme that, the so what that is, there's going to be a slight reduction in the unit rate of electricity and also gas as well. So that could, on average, potentially save the average household about £150 a year. Of course, that's going to be subject to changes in, the price cap, sort of next year as well. So we're not exactly sure of the total effect of it, but there has been a reduction, so that's going to, it's a good news story. Hopefully people feel the effect of that. Fuel duty then, that's also been frozen until September 2026. Again, a good news story. But then contrary to that, then from April 2028, there's going to be a new surcharge introduced, and that's on electric vehicles. So it's going to be 3p per mile. And then for plug-in hybrids, it's like a half rate, so 1.5p per mile. Don't know how this is going to be paid. Don't know how it's going to be assessed. Again, there's a few years to kind of get the kind of scheme implemented. The argument here is that all cars, no matter if they're polluting or not, wear the roads, and they cause damage and wear to the roads. Therefore, there needs to be some way to provide money for the government or local governments to fix that. But the main reason it really is as people transition to electricity or electric vehicles, the amount of fuel duty is obviously forecast to decrease in line with that. So then it's got to come from somewhere, right? So it's kind of like the natural evolution of things. Also, rail and bus fares and prescriptions as well. They will be frozen. I think the rail fares will be frozen for the first time in 30 years. So I'm sure everyone's felt the effect of every year the rail fares just going up and up and up. Well, good news is that they will be frozen. And then finally, something that was announced a couple of days before the budget, I think, was a increase in national minimum wage. So that's from £10 to £10.85 for those 18 to 21. And then it will go up to £12.71 for those 21 and over. So again, if anyone on listening to this is maybe got children or they're on the national minimum wage themselves, they will see an increase. What the effect will be on businesses, we're not sure, of course, because that's particularly for people in the or businesses in the hospitality industry, who employ a lot of young people. That's going to increase costs. And you take into the fact that national insurance contributions for employers was increased to 15% from April. It's just affecting businesses. That could be inflationary as well. If businesses are facing higher costs and they pass those costs on. So again, this is the kind of the difficult position that any government has to sort of reconcile, is sort of ideological changes against the kind of the economic impact of them. And clearly, that this is a Labour policy, but how it will affect growth and forecasts of growth, we'll have to see over the sort of the coming months.
Thank you so much for such an informative coverage of the recent budget. Really, really helpful to identify the key changes for us and drill it down and explain it to us. So helpful. Thank you so much. Now, how can people get in touch with you if they want to find out more about your business and perhaps employ you as their financial advisor?
Yeah, sure. So, the best way really to get in touch with me is just via LinkedIn, I would say. So
Hmm.
if search for my name, you'll see that, financial advisor and part of the St. James's Place partnership as well. You'll see me come up. But then also, if you get in contact via Alison, I'm sure she can sort of point you in a direction. But yeah, it's actually, you say, it is so important to just review things. You know, review what you have at the moment. So that could be pensions, that could be investments. Cash situation. Are you holding enough cash? Are you holding too much cash? Unless you kind of review your whole financial position holistically, it's very difficult to kind of then plan for the future, and know if what you're doing now is enough. And that's basically the main value I think that I give to my clients is, we have a long conversation. Our first conversation is always about financial goals. What do you want to be achieving, or where do you want to be in the next 5, 10, 15 plus years, retirement, whatever it might be, providing money for the children. We kind of we work from that, and that's the sort of the first thing we always establish, the goals. Then we kind of work out, okay, what have we got now? We work out the current financial situation, and I use sort of cash flow modeling software to help me kind of visualize that for my clients. So we put everything in, it kind of adds it all up, how much we're saving, and then we put these goals in. And it's going to kind of reverse engineer everything, and it's going to say, okay, based on what you're saving today and what you currently have, is there a shortfall for you to achieve that goal? It might be sustaining your current lifestyle and retirement. Well, I can tell you, based on a number of assumptions, whether you're saving enough or not, whether that's going to be realistic or not.
Mm.
And then we can work out after that. We've got a couple of options. Do you work a bit longer if you're not saving enough for retirement now, or is it one less holiday a year, or do we just save a little bit more, each year before retirement? And I can kind of help provide, a number that we need to be saving each year, and then a pot size we need to get to before retirement to kind of, help achieve goals. But yeah, of course, we do that for all types of goals. So, if that interests anyone, just having that clarity and the comfort and the peace of mind, knowing like, okay, there's kind of a steady hand on the tiller, looking after the finances to make sure we're on track. And of course, we review it every year. If that's of interest to people, then I'd welcome a conversation.
Wonderful. Rupert, thank you so much. It's been such an informative podcast, and I really appreciate you coming on and giving that summary and your advice as well. Thank you.
Absolute pleasure, Alison. Yeah, thanks for having me on.